I'll conclude with yesterday's decision by the board to increase the cash rate by a further 25 basis points to 3.6%. This brings the cumulative increase in interest rates since May last year to 3.5 percentage points. The initial increases were required to remove the extraordinary policy support that was put in place during the pandemic. Our assessment is that the more recent interest rate increases have moved monetary policy into restrictive territory, and that's been necessary to ensure that this current period of high inflation is only temporary. When the board makes its decisions each month, it's managing two risks. One is the risk of not doing enough, which would result in high inflation persisting and then later proving very costly to get down. If inflation persists, we're going to have even higher interest rates and more unemployment. So that's one risk. The other risk is that we move too fast or too far, and the economy slows by more than is necessary to bring inflation back down in a timely way. I have to say it's a complex environment in which to be making policy decisions, with many of the variables that we monitor at near record highs or lows. As I said, the inflation rate is at a 3-decade high. The unemployment rate is around a 5-decade low. Australia's terms of trade are near their highest level ever, near a 150-year high. There's been a record boost to savings over the last couple of years, and interest payments as a share of household income will soon be at a record high. At the same time, measures of consumer confidence are near record lows. So a lot of record highs and a lot of record lows. This all makes making policy challenging at the moment, and there are a range of scenarios for the economy, and there are uncertainties in both directions. Given these uncertainties, the board is monitoring the data very carefully from month to month, and we have the flexibility to respond as needed. Our judgment, though, remains that further tightening of monetary policy is likely to be required to bring inflation back to target within a reasonable time. Inflation is still too high, and while it looks to be on a declining path, it's likely to remain higher than target for a few years. If we don't get inflation down fairly soon, the end result will be even higher interest rates and more unemployment. We best avoid that. At our board meeting yesterday, we discussed the lags in monetary policy, the effects of the large cumulative increase in interest rates to date, and the difficulties that higher interest rates are causing for many households. We also discussed that with monetary policy now in restrictive territory, we are closer to the point where it will be appropriate to pause interest rate increases to allow more time to assess the state of the economy. At what point it will be appropriate to pause will be determined by the data and by our assessment of the outlook.